So you've learned the basics and you're ready to get started. You've done your due diligence on your own situation and have determined how to come up with a strategy for investing. Now we've got to build a portfolio. Welcome to Mr. Darston's Beginning Your Investment Journey, Part 3. Let's get to that portfolio construction now. Now, a good portfolio that I've tested over the years and that I like for someone getting started would be a portfolio that had a number of different ETFs in it. You can get into it with $1,000 or a little bit more, somewhere in that ballpark, and kind of have equal weighings in each holding. And that would be to have maybe a NASDAQ index-based ETF, a Dow Jones Industrial Index-based ETF, exposure to small companies, so a small cap index-based ETF. The biotechnology, health sciences industry is one that seems to always be throwing out some innovation and it's been a great performer over the last couple of decades. So to have some exposure there as well makes sense. And then, of course, I mentioned having that hedge in your portfolio, fixed income bonds, in this case, long-term U.S. Treasuries as a part of your portfolio. Having a mix of 20% in each of these holdings dating back to 2007 has yielded nearly 12% per year. In the worst year, of course, was 2008. This portfolio was down around 20, 21%, whereas the actual market, or in this case, we're talking about the S&P 500, was down roughly 37, 38%. So this has yielded as good, if not better, returns over time, and it has proven to be less volatile because it's diversified amongst different industries, amongst different asset classes, and it does have that hedge and some fixed income as well. So this portfolio has proven to be one that I've employed, and I think it'd be good for a new investor starting off because it's going to help you be diversified. It's not going to cost a lot of money to own each of these positions in your portfolio, and you'll be well on your way to getting the type of growth you want from investing by having something like this to start off with. So to put a bow on everything and summarize what's important here as our takeaways. Number one, you want to invest with your goals in mind. Think about your time frame for investing, the reason you're investing, what you're trying to achieve in the end. Is it for retirement? Is it for a short-term goal? What is the reason you're putting money here? That will help you determine how much risk you want to take and how much exposure you want to have to the more volatile elements that are in the market. Um, I also advise you again to use a brokerage firm or broker that has an easy to use platform and also one that offers free trade. So when you're buying and selling your positions, whether they're stocks, ETFs, or whatnot, you don't want to be hit with large trading fees or any trading fees really. So you want to find or use one of those that I illustrated earlier. They all have free trade offerings. Again, to emphasize this over and over, I'm glad to do, and that's diversify your investments. Don't put all of your eggs in one basket. Getting different asset classes, um, different industries is very important. It's going to help your portfolio perform over time and minimize your risk. Also, be consistent in contributing. Make it a habit. Uh, the market is not made to create your wealth. What the market will do, what investing will do for you, it'll help grow your wealth and it'll help protect your wealth from inflation. So you really need to commit to saving because that's how you build wealth. You just add to its value by investing. And last, do not forget to rebalance. Now, when you start off your investment account, you'll have an investment objective in mind that'll help you determine how much exposure to risk you want to have in your portfolio. Over time, those positions are going to change. So some things will grow at a faster pace than others, and your exposure will change based on how your portfolio makeup is at a given time. Because your portfolio will change, you want to put a mechanism in place to get things back in focus ever so often so things don't get too skewed over time. That's what rebalancing is. If you have a 20-20-20-20-20 split, between 5 different holdings, over time something might get up to 30%, and that's going to drop something else down to maybe 10. Well, you want to get back to that 20-20 percentage for everything. My recommendation is to rebalance annually or biannually. That way, you'll keep everything intact. I do not recommend rebalancing more than once per year because doing so could trigger an increase in tax liability because you will have a short-term capital gain should your accounts appreciate that you'll have to pay as opposed to a long-term capital gain. And the capital gains tax rate is less for long-term capital gains. So all that said, do your due diligence, start. I can't emphasize enough how important it is to get started. Time is your friend. The sooner you get started, the better. But make sure you employ the advice that you've been shared with in this video. Thank you for your time. Happy investing.